All right, thanks for joining me on Journey with James. And today we're going to take a look at our economy. So join me as we talk about what in the world does this picture do with our economy, right? So I heard this statistic or heard this the other day, and I just had to Google some things, right? So let's jump right in. Percentage of Americans not paying bills. You get credit card bank report. You get struggling to make 40% of Americans struggle to make ends meet. You get all of these things, right? Um, so let's just go into this. So let's take a look at the economy on the top side, and let's see what it's doing as a macro, as a big giant whole. So I love this chart by Lineage. I love charts. It's a little wonky on the Qs because it's like every 9 months, right? So here in this is gonna come up when we talk about 2020 the recession there. So it starts at the Q4 in 2019 and jumps to Q3 in 2020. And it's really hard to really find a line down to figure things out, but I'll guide us. So, outstanding credit card balances, we see it tick up since 99. We had the 2000 split. It kind of went down and it started, the crash in 2000. That was the dot-com crash. Came up, keeps going up. And this is, uh, was it trillions? I'm sorry, let's see here. Um, so Americans have an absolute amount of credit card, 1.142 trillion to be exact. So this is hundreds of thousands or hundreds of millions. Sorry, billions. Excuse me. So right before you see it ticking up, so during the 2000 crash, it was roughly about like 530, 540 billion in credit card debt as U.S. consumers in whole, right? And it kind of comes down a little bit, then pops right back up, comes down a little bit, pops right back up, and keeps going up and up. It has these slight curve downs and then pops back up, right? And then you see it make this huge crest. When was that? Well, that was a lot of '07, okay, um, but slightly some in '06. They had some big moves, and a lot in 2007 through 2008, right? And then it just comes crashing down, right? So, and that was pretty much the end of 2008. So what would make it crash down, right? People are two things. One, people pay their credit cards off. Again, these are just credit cards. These aren't like mortgage payments, auto payments, stuff like that. They pay their credit cards off, or they default, and the credit card company wipes and calls it a loss. Those are the two ways that you can get your credit card off, right? It goes down, keeps going down, and it gets better through 2012. This is when about 2000 in 2011, definitely 2012 to 2015, maybe this is when we had a very good recovery from the recession, right? So this is kind of like almost like an opposite recession indicator, right? Or actual recession indicator. When it comes like this, that means we're going into or in a recession. When it's got this low depth to it, that means we're recovering and things are really good and strong. The economy is very strong because it's about to have some upward movement. And with that upward movement comes some credit card debt, right? And you see it go up and down, up, down. People put stuff on, take it off, put some on, take it off type thing, but it still keeps gradually getting higher up until 2019. Now, a lot of people don't know what was happening in a macro term in 2019, right? Everybody just skips forward to 2020. Let me tell you, in 2019, everyone was talking about recession fears, like credit things were going to break. And then, sorry, always yawning in my videos. And then 2020 happened, and if you were paying close attention, we got to see how bad the economy was because basically, within the first few months of the pandemic, right? I can't say that word anymore. First few months of what happened in 2020, the cerveza sickness, as some call it, corona type thing, the beer. But if you had a company that was flew people in the air or took them off by ship, so like any airlines or like cruise ships, right? You were broke in 3 months, and the government had to bail your rear end out. Okay, that is not it's not a good business model. Number one. Number two, it just goes to show you if these parts of travel and leisure are so by the margins at this time in history, right? The economy is not doing well. So a lot of people were expecting a recession in 2020, 2021 anyway. What happened is we had a blink of a recession. I would say COVID kind of forced a recession, right? But then the government came out and bailed everybody's rear out. So they threw $5 trillion of dollars printed out at the problem, printed out 25% of the amount of dollars of all history that of in dollars that were made in a period of like 6 months and threw it at everybody, right? What happened? People started paying off their credit cards because they're scared, right? So they, hey, we're gonna pay down our debt, pay down our debt. And then at the end of 20, early 2021, we started to feel a peak of inflation. People started to get a little comfortable because, hey, most people had to have the virus by then. There's vaccines now rolling out in 2021. And so people start spending again, right? So also inflation hits pretty darn bad at that time. And it keeps climbing and climbing and climbing. And this is the highest height. I mean, if you look at this peak from the 2008 to the 2019, 2020 crash, it's only off by like 100 billion, right? Or less than 100 billion. This is going from about, I'm going to estimate about 930 billion to over 1.1 trillion, right? And so remember what these said about recession indicators, right? If they're really high, if they start to crest super high, then you get a recession. This is starting to be an indicator. It's just one of those green lights in a row that on your, or one of those indicators on your dashboard in your car that says, hey, there's a good chance we're heading to a recession. Okay, and this is the dip down and then the skate up, the dip down, the skate up and fall, the dip down, skate up, kind of a dip down, skate up and fall. Yeah, it's gonna happen, and it's gonna happen bad. And by the way, just because this dips up doesn't mean the recession start. The recession started in 2000, late 2007, early 2008, which was like right around here. So even through the recession, credit went up, right? And it's not till the recession breaks everybody that credit card balances go down. So we could see this go up. We could be in a recession by like here, like 2025, and still go up through 2025 and break down at the end of 2025, early 2026. We'll see. Time will tell, but it's an indicator, right? Here's another one we're going to talk. We're going to look at. Financial was 40% of Americans anxious about bill payments. Also, 55% was whose annual income is less than 50,000 worry about the same thing, not having enough money to pay their bills. These results highlight how many Americans are still feeling the pinch of increasing prices and living costs, even as economic indicators show as unemployment and moderate inflation are helping to alleviate. I think that last piece is very uneducated. I'll say it very kindly about that. But there is a large percentage of Americans anxious about bill payments, right? And it is probably the low class and middle class, lower end of the middle class, right? I think the middle class, everyone's feeling inflation, right? Even I'm on the top 2% of wage earners in the U.S. and probably point whatever percent in the world, right? I'm feeling it. I'm starting to sense inflation, right? Does it ruin my plans? Does it stop me in my tracks? Like, oh, I can't buy that. No, it doesn't. But I'm starting to see it, right? It's kind of like a mosquito to me. You know, you hear the buzz and you feel the pinch, like, okay, you slap it and like, all right, go on with your life. It's not like a mosquito net that is catching some people and causing them to change their behaviors, change their habits, right? I'm just feeling it. I'm experiencing, like, oh yeah, peanut butter is going up again. Hey, I look at my grocery bill for me and my dogs. I'm like, holy cow, this is insane. Does it stop my normal? Am I gonna stop buying groceries? Am I gonna change things? Not really. You know, I might be eating more chicken because I'm trying to thin down, but not because of inflation, right? The average American is not that way. And the average American is what builds the foundation for the upper middle, and other classes to build their wealth, right? This is why the middle class is so important. And right now, they're feeling a lot of anxiety about making their bills. So, as those of us who invest in markets, we need to pay attention to this. All right. Bank rates credit card report. Let's see here. What is it? Okay. The resulting data weighed to the present of U.S. adults shines light on American struggles with credit card debt. As of June of 2024 polling, 50% of credit card holders carry credit card debt from month to month, right? That's scary. So in other words, they're just paying off the minimums or paying the minimums plus a little bit, or paying the minimums plus their next bills and then putting no more bills on it. So they're in credit card debt month to month. They're not solving the credit card problem, right? And that's when we eat them alive, especially as credit card rates are above 20% now. Right? It's highway robbery. According to Bank Rate's latest credit card debt survey, this is up from 44% in January 2024. It's the highest percentage Bank Rate's polling since March of 2020. Again, that was the scary time when COVID hit, right? If we go back to this chart, bam, oops, sorry, over here, bam, that's somewhere right here. When 60% of credit card holders carry debt from month to month. I'll finish with this. Since the beginning of 2021, credit card balances have been off to the races. High inflation, high interest rates have ruined American savings, and more people are carrying more debt for longer periods of time. Again, this is not me and probably not you that's listening to this, but this is the average American, right? This is the mom and pop, the average person who's just working a 40-hour week, 9 to 5 job, has a stable pay while everything else goes up. Their pay stays the same, and they are struggling. They're the person that buys your house that you're gonna flip. They're the person that uh, puts their gas in your car. They're the person that gives to their 401k to put in your stock market, right? They're the ones that possibly bought a little bit of Bitcoin, 0.25% or 0.025 of a Bitcoin, right? Um, these are the people that um, are our customers, our clients, all right? They are struggling right now. When they struggle, they're going to look for things to cut if they can, and if they can't, and it keeps going on, things will break and they will be forced to cut. Struggling to make ends meet, 40% of our struggle to pay bills. Kind of exactly the same what the last one said, but it's got a video attached to it. I'm not going to play for you. All right, let's move into this is credit cards, right? Let's move into mortgage rates. And I didn't look this one up as well beforehand, but the mortgage rates are going up. In fact, one of my notes on this video is I don't know about you guys, but I've got some owner finance properties. That is where basically I finance the property out myself. So instead of paying Chase, Wells Fargo, whatever bank, they pay James, right? They pay me that interest rate. And some of them are having trouble paying their bills. They're constantly chronically late. I mean, this is like the third or fourth month that they're late on their payments, right? Um, things are they have not been late for like a year, two plus or more, right? I don't think they've ever been late. And then all of a sudden, the last 3 or 4, the last 6 months, they're getting late fees, right? These are all symptoms of a problem that is growing that we need to pay attention to, right? All right, let's look at this. So all this is happening. We're looking at Psalm rule. Psalm rule is great stuff, right? All this is happening. We've got high credit card debt. We've got people struggling to pay their mortgage. I can look at that statistic later, but high credit card debt. People going month to month on credit card bills, right? Highest credit card bills our nation has ever experienced as consumers, by a long shot too, right? What is this? Like what percentage is this? Like 20%, maybe 30%? I don't know. Um, and at the same time, the Psalm rule has just been triggered. And I did a video on the Psalm rule about 4 to 6 months ago. Ask me, I can get it to you. But what is a Psalm rule? And it's Psalm SAHM is a recession indicator that signals the start of a recession when 3 months moving average of the national unemployment rate, U3, rises by 0.5 percentage points or more relative to the minimum of the 3 month averages from the last 12 months. So, what does that mean? 3 month average, if it's greater than half a percentage than the 12-month average for unemployment, the Psalm rule says, hey, we are starting a recession. Okay, so let's talk about quarters. If in this quarter unemployment raises by 0.5% points more than what it did last year, the Psalm indicator goes off. Well, let's take a look because Fred is our friend. kind of is the federal government. But Fred gives some good charts, right? Here's the SOM indicators. It goes all the way back to 1960. We're not going to go that far. We're just going to highlight, hey, 2000, the dot-com bust. Remember, it popped up. It was 0.3, 0.2, 0.5, 0.4, 0.47, right as we get into a recession. Okay, and it peaked out at 0.163, went down, kind of choppy. Let's see here in the Great Financial Crisis, right? The last recessions, it went up when it hit zero point 0.5, it skyrocketed, right? So here's another thing: once it hits 0.5, it typically just goes straight north, right? Here again, 2019 is a little different, but it just went straight parabolic, just way up there, right? Because everybody was getting furloughed or laid off, right? It's kind of a misnomer to me. I don't really count this as a recession because it was so awkward of a time. I really look back at these two, okay, for guidance, and I think this was honestly, I think it was a delayed recession. In other words, we were in a recession. We need things to clean out. The government stepped in and they just delayed things and made them much worse. Where are we at now? 0.53. Kind of scary. If you put all these things together, right? High credit card debt, late mortgages, unemployment going up, you get this. Well, you get this. You get a house fire that people are sitting in, and the question is really, what do they do? A lot of times people think you're going to say, hey, things are being okay. You and me, let's not do that. Especially that last part looked like Indiana Jones in a cartoon. But let's not sit in our house and just go on fire, right? We know the probability of a recession is very, very good in the future, right? A recession brings everything down with it. I don't care what it is. If it's gold, if it's Bitcoin, if it's real estate, if it's oil and gas, recession is going to pull everything down and it's going to push one thing up, and that is the value of the US dollar. Okay. Now, none of this is what I'm about to say, or what I have said is financial advice. It's just me, this guy with blue hair every once in a while that has had experience investing, saying, hey, this is what I think, what I'm going to do, what I think is prudent, but it is not advice whatsoever. I don't want you to lose all your money, so don't follow me, right? But in a recession, everything gets pulled down. This is how it works, right? The average person, the people we talked about in this, aren't making money. They're in over their heads in credit card debt. It's going to eat them alive, and they're going to be late on all their payments and mortgages included. Okay, they're going to start to sell things in order to pay the things that they need. Right? If the credit cards shut them down, okay, they're not going to use credit cards at the store. What are they going to do? They're going to use cash or debit. All right. If they get a foreclosure statement on their mortgage, what are they going to do? Well, they might sell maybe some stocks or their Bitcoin or their gold, or they may cut back on they'll probably not cut if they have a job. They'll probably not cut back on driving to work, right? But hey, it's really cool at night. Let's just turn the AC off and open the windows up. Save a little money type thing, right? Those types of things. They're probably not going to go on that vacation. They're probably not going to rent that Airbnb. They're probably not going to do this XYZ ABC. They're going to start cutting back massively so that they can afford, they can try to pay their mortgage payments, right? So in that, it's going to pull everything down. Real estate, gold, Bitcoin, houses are going to sit on the market. People aren't going to buy as much. People are going to get foreclosed on. It just happens in a recession, right? People are not prudent. People are they get caught up in FOMO, they get greedy, they're like, hey, real estate only goes up, and then they get caught at the peak of everything right before we fall. And this is, if you go through a chart of real estate in the great financial crisis, you probably see this about the same thing or similar, right? Everything goes down. There's one thing that goes up, and that is the dollar. Okay, that's what everybody's needing. When they pull the drain and all the water rushes down, what people need is water. The water to the economy is currency. It's the U.S. dollar, right? So one thing that I am doing, it's up to you if you want to do this too, again, not financial advice, is I'm doing two things. What? Number one, I'm going to start pigeonholing dollars a little bit. I'm going to start to get that savings account up a bit. I'm going to start, if I do have bad debt, like credit cards or something like that, I'm gonna start paying that down, making sure that is at a zero for me. That'll help my credit. And when you pair that with cash flowing assets, lenders kind of like you a bit more, right? And then you can really start to save. Because if you've got credit cards at 20%, at 20%, I don't know what investment will pay that, right? It's probably better instead of buying an investment, probably best to pay that down if you get my drift. Okay, so we've got that. We've got so saving money, paying down bad debts. So homes with fixed rate interest rates, autos with fixed rate interest rates, education with fixed rate interest rates. Those aren't really bad debts, right? Credit cards, things with variable interest rates. Those, I mean, if you're not hurting on those already, you will be very soon, right? That's number two. Number three is if I have availability, if I feel like I have a lot of cash, maybe too much cash right now, I'm putting my cash into cash flowing assets that have no little to no liability, right? Or they can produce that can outrun their liability. All right. So what does that mean? Well, when I talked about latent mortgages, right? I've got an owner financed home. That is an investment for me. Okay, that is a home that I have put up for sale, that I charge an interest rate to the new buyer, and that I pocket it. Right now, I have an underlying mortgage into that, so it's technically called a wrap, right? And so I've got maybe a mortgage of, let's just say, $1,300, right? And their payments with interest, all that stuff is like, $2,700 or something like that, right? And I'm making 1,300 in the spread. Okay, I'm taking into consideration that she might default on that. And instead of me making $1,300, I'm now paying 13 or 14 or $1,500 out to keep that house in my in my name, so the bank doesn't take away from me, right? So the tax man doesn't take away from me, so the insurance company is paid, and so it doesn't burn down, right? I have to take a look at that and say, hey, with my current savings and my current income, that is, if you can say recession proof, right? I give you W-2 if you're really comfortable in that, but mostly with your savings and your cash flow, saying, hey, how long can I weather that storm, right? If I think, she defaults today and she doesn't pay, and we give her like, hey, by the end of the month, and then next month she does it again, like she's got 2 months in a row of not paying, and I say, okay, let's file for foreclosure, let's get that in. Oh, look, there's a lot of people filing for foreclosure. I've got to hire, after hiring an attorney, all this stuff. There's going to be just a glut of it, and it might extend out to like 6 months. Do I have 6 months of savings of $1,300, $1,400 saved in my bank to cover that, right? You got to do the math on that, because here's the snowball. If I've got 10 properties like this, to where it's $1,500 a month for me, at the end of the day, I'm making 1,300 each property. If 5 default at the same time, that's what, 1,500 times 5, that's 5, that's 8 grand a month. That's $8,000. But I'm not making that much on the other properties, guys. All right. I'm going to come up short somewhere. I have to make sure those are covered for at least 6 months, right? Hopefully it'll take shorter than that. But if I don't, and a lot of people in real estate don't, they're just throwing everything they time to get money in, they just throw it back out there, right? Which there is a time for that, when you can over leverage yourself, and it works out to your benefit. But now is not that time. Like with debts all the way up to here, here's the time you want to do that. Again, not financial advice. This is the time I look for doing that. Not up here, not up here, and certainly not way over here. Okay. Um, there's a lot of people that are, and they're going to get taken down with their clients and renters and stuff, because they're not being prudent. They're getting FOMO, and they're thinking everything's just going to get more expensive, so just throw money out there and invest, and they're going to get their rear ends handed to them. Not because they're doing a bad job of business. Well, I shouldn't say that. Not because they're not good at selling houses, or getting rentals, or they're not because they're not investing, because they're not taking risk into consideration. They're not doing the math, and they're letting FOMO or fear of missing out on something really make them too risky, right? And so this is how you get investors that get foreclosed on in recessions, because, like I said, they got 10 properties. 5 default, those other 5 can't cover themselves and these other 5 properties, they're gonna have to sell 1 or 2 or something, right? So I'm holding cash. I am paying down bad debt. I am taking inventory of my liabilities, okay, just in case something bad really happens. And then the fourth thing is, um, I'm putting cash into cash flowing assets that don't have any liabilities. In other words, I've got a lot of mineral rights that give me cash, tons of cash every month, that have no liability, they have no downside, right? And that's what I'm a huge fan of right now. Now, if you're interested in that or you want to know more about it, give me a call, shoot me an email, contact me today. We can get you set up with somebody, give you some education, everything like that. But the biggest thing is just prepare for the worst, because every big every big brain I'm listening to, every big investor like Warren Buffett just sold, I think, like a few $1 billion or $500 million or more of Apple, right? Apple's a great company. Why is he doing it right now? Because he right now has the largest amount of cash on the sidelines that he's ever had in his life. Something big is coming, and I want to make sure that you're prepared for it and that you're not like these guys sitting whether you're an investor or not, because they'll be at this table too if they're over leveraged. I don't want you sitting at this table saying, hey, I'm okay with this. Everything's going to be fine. I'll just stick my head in the sand and this happens to your life and your investments. Okay? Um, I want us to be prudent and have more and get through this and be more like this guy. Look at that. Isn't that amazing? All right. My name is James. I'll leave you with that. Reach out to me today. We'll get you set up.